Every trader begins with the same dream: freedom. Freedom from the boss, from the grind, from limits. But the irony is brutal. Most traders destroy themselves chasing that freedom. They don't die from bad markets or bad analysis. They die from the same poison: too many trades. Overexposure. It's not the market that ruins them. It's their own inability to stop. You can have 10 brilliant entries and still lose everything, not because you were wrong, but because you were spread too thin to survive the storm. Professionals know this. Amateurs don't. The amateur believes more trades mean more chances, more action, more potential. But every extra position is a slice of vulnerability. Every click without discipline is another leak in the ship. Jesse Livermore, the legendary operator who rode both fortunes and ruin, once said, "It was never my thinking that made the big money. It was always my sitting." He understood something most never will. The market doesn't reward movement. It rewards mastery over oneself. Yet most traders can't sit. They crave the next candle, the next dopamine spike, the next sense of engagement. They confuse activity with progress. They think that if they aren't doing something, they're falling behind. But the market doesn't care about how busy you are. It only measures how well you manage exposure. That's the invisible difference between the professional and the amateur. The amateur trades to feel in control. The professional trades to stay in control. Those are not the same thing. The amateur opens 10 trades to feel engaged. The professional opens one and watches the tape like a sniper watches a target. He's patient. He's detached. He knows that each additional trade doesn't increase his edge, it dilutes it. Livermore called patience part of the profit. That idea sounds simple, but it's radical. Waiting, observing, not trading. Those are forms of control. They are positions in themselves. Most traders don't realize that every open position has two costs: capital and psychology. Each trade occupies emotional bandwidth. Each trade adds noise to your perception. If you're holding 10 trades, your ability to see the market clearly drops by 80%. It's not math, it's human limitation. Your mind can't hold that many conflicting signals, stop losses, and unrealized profits without losing clarity. Professionals understand that mental fatigue is real risk. They know that exposure isn't just financial, it's emotional. And emotional exposure is what kills the best minds in this business. So professionals design systems to protect themselves from their own impulses. They use the 20 trade limit, a self-imposed ceiling on activity. 20 setups per campaign. No more. It's not superstition. It's self-defense. Why 20? Because it's just enough to allow expression, but not enough to allow chaos. Beyond that number, quality collapses. The law of diminishing focus takes over. You start trading noise. You start chasing shadows. The limit forces you to make choices, to value each setup as if it's precious because it is. Think of it like ammunition. A disciplined trader begins each campaign with 20 bullets. Every entry costs 1 bullet. When you know you can't reload, you aim differently. You wait for confirmation. You study the tape. You align conviction with risk. You think. That's what separates professionals from the crowd. They know patience is not waiting for nothing to happen. Patience is waiting for the right thing to happen. Now, here's the paradox that turns the whole game upside down. The smaller your number of trades, the greater your odds of survival. The average retail trader believes diversification across dozens of positions is safety. It isn't. It's diffusion. It's spreading your focus so wide that you can't see where the real risk lies. When volatility hits, all those trades you thought were separate start moving together. Suddenly, you don't have 10 trades. You have one big correlated bet against yourself. That's overexposure. That's how great traders fall. Professionals use limits not to suppress instinct, but to channel it. They know the market rewards concentration and punishes distraction. 20 trades create structure. Structure creates patience. Patience creates precision. And precision, that's where profit lives. The amateur keeps shooting until the gun jams. The professional stops after 20 and studies his results. He treats trading like surgery. deliberate, sterile, focused. This idea is older than algorithms. Livermore lived it in the bucket shops, where he learned that doing less with more focus produced more consistent outcomes. He would sit for days, sometimes weeks, watching the tape without touching it. Other traders mocked him for not trading. They thought he was frozen. They didn't understand that he was waiting for alignment, the convergence of price, volume, and emotion that signals opportunity. When that moment came, he acted with speed and size. That's what sitting really means. It's not inactivity, it's coiled readiness. The amateur mindset is wired for constant validation. It treats every moment outside the market as wasted. That's why they overtrade. They want the feeling of participation, the illusion of control. But markets aren't playgrounds. They're arenas of probability. Every decision consumes emotional energy, and once that's gone, discipline goes with it. The 20-trade limit creates a psychological firewall. It prevents the emotional contagion that spreads when you're juggling too many positions. It teaches restraint through structure. There's also a financial truth behind the limit. Let's say you risk 2% per trade. With 20 trades, your total campaign exposure is theoretically capped around 40% if everything went wrong, which is survivable. But if you take 60 or 80 trades with the same risk, you're courting ruin. Not because you'll lose all of them, but because variance will eventually catch you in clusters. Professionals know survival is a numbers game. They play for longevity, not excitement. They understand that the first rule of trading is stay in the game. You can't win tomorrow if you blow up today. That's the psychology behind the limit-forced selectivity. It transforms scarcity into strength. When you know you have only 20 shots, you filter harder. You wait for quality setups. You stop reacting and start anticipating. You begin thinking like a professional, not a gambler. You stop asking, "What can I trade today?" and start asking, "What's worth my capital, my time, and my emotional bandwidth?" That shift changes everything. Still, most traders resist this rule. It feels restrictive. It feels like missed opportunity. But the truth is, opportunity in markets is infinite. Your discipline is not. The 20-trade rule isn't about limiting profit. It's about conserving energy for the moments that matter. The fewer decisions you make, the higher their average quality. Every trade you don't take creates more clarity for the ones that count. Livermore often said that a man's biggest enemy in the market is his own impatience. When you understand that, you start to see trading differently. You stop chasing the market and start letting it come to you. You begin to experience the strange peace professionals talk about, the calm before action. That's what the 20-trade limit cultivates. Calm under pressure. It's the antidote to the chaos of overexposure. Most traders will ignore this advice. They'll keep clicking, keep chasing, keep drowning in noise. They'll believe discipline is optional, that the next trade will make it all back. Until one day, it doesn't. Until one day, the market teaches them the cost of too many trades. The lesson always comes. The smart ones learn it early. The rest learn it when it's too late. So ask yourself, are you trading to feel alive, or are you trading to stay alive? The first path burns bright and ends fast. The second path feels slow, but it lasts. The difference is discipline. The difference is limitation. That's why professionals don't fear limits. They embrace them. The limit keeps them sharp, selective, and sane. It's not a punishment. It's protection. The amateur sees 20 trades as a cage. The professional sees it as armor. And yet, there's a lingering question, the one every trader eventually asks. Why 20? Why not 10, or 50, or 5? What makes that number so powerful? Where does it come from? Mathematics, probability, or experience? In the next chapter, we'll peel back that logic and expose the truth. The 20-trade limit isn't just a rule. It's a scar, a boundary drawn from blood, from loss, from survival. Let's start by dismantling the most dangerous illusion in trading. The idea that more trades automatically mean more profit. At first glance, It feels logical. You're active. You're in motion. You're chasing opportunity. But the reality is brutal. If you risk 2% of your account per trade, 20 well-considered trades give you a controlled 40% exposure for the cycle. That's survivable. That's calculated. That's professional. Now, imagine 80 trades under the same conditions. The math alone begins to show cracks. Variance compounds. Fatigue accumulates. Emotional bandwidth drains. Suddenly, you're not managing 80 trades, you're managing chaos. Each additional trade increases what's known as correlation risk, the invisible overlap between positions that most traders never notice until it's too late. You think you're diversified, but when the market moves, all your trades start moving together. 10 small bets can suddenly behave like one giant mistake, and the damage is magnified. A veteran once told me, when the tide turns, you don't have 10 positions, you have one big mistake. That phrase alone should haunt every aspiring trader, because it encapsulates why amateur approaches fail. Professionals don't count trades for entertainment. They calculate aggregate risk. Every position is a withdrawal from the same account of emotional and capital resilience. You only get so many bullets before fatigue, bias, and revenge trading start to erode judgment. Livermore's approach was extreme yet instructive. He would watch the tape for weeks without touching a single position. Patience is part of the profit, he said. Notice the subtlety. He wasn't advocating laziness. He was highlighting the calculus of risk and the compounding cost of unnecessary action. In contrast, modern traders replace patience with click speed. The impulse to act masquerades as productivity. Overexposure begins not because of greed, but because impatience, disguised as effort, infects judgment. Professionals, however, know that each trade is a finite resource. The 20-trade limit exists to force scarcity, which forces selectivity. Every trade must justify itself. Every setup must earn its place. Trade less, think longer, survive infinitely. Scarcity is not punishment, it is armor against ruin. Let's quantify this further. If you assume 2% risk per trade, 20 trades accumulate to a total exposure of roughly 40% if every trade goes wrong. That's acceptable for a professional's risk appetite. Now, extrapolate to 80 trades at the same 2% risk. Exposure skyrockets, not linearly, but exponentially, as overlapping positions, emotional fatigue, and hidden correlation converge. Even a single unexpected market movement can trigger cascading losses. Professionals internalize this reality. Amateurs deny it until catastrophe hits. This isn't theory. It's probability applied to human limitation. Each trade consumes attention. Each decision chips away at composure. Without a cap, the probability of ruin doesn't just rise, it becomes inevitable. The 20-trade rule is, therefore, a statistical shield. It ensures that you maintain control over your capital and, just as importantly, your psychology. Without such boundaries, even a brilliant trader can be undone by their own activity. The emotional dimension is as critical as the financial one. Each trade is not merely a risk of capital, but a strain on mental resources. Cognitive fatigue is an underestimated killer. Studies show that humans can only process a finite number of complex decisions before judgment degrades. In trading, that degradation manifests as impulsive entries, poor position sizing, and deviation from strategy. Professionals recognize the need to ration attention with the same rigor as capital. They understand that when emotional reserves deplete, probability no longer works in their favor. The amateur, oblivious to this principle, assumes experience will compensate. It does not. Survivors, those who endure market cycles and emerge profitable over time, are those who impose artificial scarcity. Scarcity, in this context, does more than protect. It educates. By limiting trades, the professional is forced to differentiate between noise and signal. They learn to value conviction over impulse, clarity over activity, patience over motion. Scarcity rewires psychology. It transforms waiting into a deliberate, active position. Waiting is no longer passivity, it is calculated engagement. While amateurs fidget, scanning endlessly for setups that aren't there, professionals observe, filter, and wait for alignment. The tape becomes a teacher, not a tormentor. The 20 trade rule converts inactivity into advantage. It converts restraint into a weapon. Consider this scenario. A trader is tempted to enter 3 new positions on the same day because the charts appear hot. If unrestricted, the emotional surge feels productive. In reality, each additional position dilutes the probability of rational decision-making. Each step away from the cap increases correlation risk. In a volatile market, those 3 positions may react identically, amplifying losses instead of distributing risk. The professional knows this. They know that the fewer trades you take, the higher the average quality, and the greater your survival odds. They understand that probability favors patience, not activity, and that each trade's value rises with scarcity. Furthermore, limited trades enforce post-trade discipline. When you know you have only 20 opportunities, you analyze every execution more rigorously. Stop losses, risk-reward ratios, and timing become not just protocols but habits. The psychological reinforcement of each counted trade conditions behavior. You stop overtrading because you are constantly aware of the finite pool. You learn to trade with intention rather than reaction. Over time, this cultivates a mindset aligned with professional standards, thoughtful, selective, and resilient. It's also critical to understand how overexposure interacts with market variance. In trading, bad outcomes tend to cluster, not disperse evenly. If you take too many trades, you increase the likelihood that multiple positions will experience adverse moves simultaneously. This effect is subtle and often invisible to the inexperienced eye until catastrophic losses occur. Professionals preempt this by limiting frequency, forcing each trade to stand on its own merit and reducing cumulative risk. Every additional trade beyond the limit is no longer opportunity. It is a lottery ticket, sold at the cost of clarity. The 20 trade limit is not arbitrary. It is derived from a balance between survival probability and opportunity. It is large enough to allow expression and profit, small enough to prevent cognitive overload and emotional erosion. Each trade becomes an event of significance, not noise. This structure protects capital, preserves mental bandwidth, and enforces long-term viability. Professionals understand that longevity is the ultimate leverage. No single trade matters more than the cumulative advantage gained from disciplined restraint. The amateur often misses this point, conflating activity with mastery, and suffers accordingly. Finally, consider the broader lesson. Trading is not about action. It is about managing risk, attention, and emotion. Each trade is a finite resource. Each decision carries psychological cost, and each added trade increases exposure to the uncontrollable. The 20 trade rule encapsulates these realities. It forces deliberation, transforms patience into an active position, and aligns execution with probability. Trade less, think longer, survive infinitely. Professionals live by this rule. Amateurs break it and pay the price. When you respect scarcity, every decision sharpens, every signal gains meaning, and every opportunity that aligns with your edge carries maximum weight. Without this discipline, overexposure will quietly erode your edge, and no amount of skill or insight can compensate. Minus side of Avida side, the sake phrase, one side of, the side of Ida side, when you rated ever the side of Ida side, when you main is seen with his one side of, when you sains the side of Ida side. In the next chapter, we will explore how this limitation rewires the trader's psychology, transforming waiting into a position of active engagement, turning patience from passive endurance into a tool for deliberate profit. This is where the true advantage of the 20 trade rule lies, not in the mechanics of risk, but in the mastery of mind. By understanding and internalizing this principle, You begin to trade not as a reactive amateur, but as a calculated professional, capable of surviving and thriving through any market cycle. Here's the hardest truth in trading. Doing nothing is still doing something. It sounds counterintuitive because our instincts scream that action equals progress. But in markets, movement is not always mastery. The amateur measures success by activity. They want to see orders on the screen, candles forming, confirmations triggering, as if engagement alone equates to skill. Every flat day feels like lost time. They fear missed opportunities so intensely that they enter positions prematurely, overextend risk, or chase setups that have no real edge. Meanwhile, the professional sees the opposite. Waiting, truly waiting, is an offensive position. It is an active choice. It is a controlled, deliberate engagement with the market. It is not passivity. It is strategy. To understand this, consider Jesse Livermore, who famously watched the tape with a surgeon's patience. He made his fortune not just after executing a perfect trade, but before, sometimes sitting for days, weeks even, waiting for alignment. He knew that impulsive entries weaken the next decision, that emotion compounds when unchecked, and that patience itself carries a profit. Every action has a cost, emotional, cognitive, and capital. The moment you act without conviction, you drain all three. That is why the 20 trade limit is so powerful. It transforms, waiting into a tool of preservation. Each trade becomes intentional, each decision deliberate. Limiting the number of entries forces the mind to filter harder, to scrutinize setups with precision, and to act with clarity. Waiting is no longer passive. It becomes a position of its own. It protects capital while simultaneously preserving the emotional stamina needed for decisive action when opportunity arises. I remember mentoring a trader who previously took 80 trades per month, scanning for anything that looked promising. His results were mediocre, inconsistent, and emotionally draining. We implemented a strict limit, 18 trades per month. Suddenly, his approach changed. He waited longer. He acted with more conviction. He studied the tape with renewed focus. The results were staggering. His profit didn't just improve, it multiplied fivefold. The lesson was clear. Fewer trades, forced quality, focus, and discipline. Energy that was once wasted on mediocre setups was now preserved for meaningful positions. If you can't sit still, you can't sit rich. That maxim is more than a catchy line. It is the psychological core of professional trading. The amateur panics at stillness, mistaking waiting for stagnation. They fill empty screens with action, thinking momentum is gained by movement. Professionals understand that stillness is a weapon. Waiting creates leverage because it allows the trader to capitalize on only the most favorable probabilities. Scarcity sharpens focus. Patience enhances judgment. Limiting trades forces the brain to prioritize, assess risk meticulously, and execute with conviction. When every trade counts, hesitation becomes discipline rather than indecision, and action becomes precision rather than noise. Waiting also rewires perception. The amateur constantly scans for confirmation, for signals that may not exist. They react to every price tick, every news headline, every social media whisper. The professional filters all this noise. They watch the tape like a hawk, noting volume, price behavior, and pivotal points. But they wait for alignment, for the market to present itself. Waiting is active observation, not inaction. Each moment spent without taking a trade is an opportunity to refine intuition, assess risk, and prepare mentally. Over time, this cultivates a kind of market radar unavailable to those who trade incessantly. Every trade becomes a signal, not noise. Every decision deliberate, not compulsive. Consider the cost of overtrading in terms of emotional capital. Every impulsive entry adds cumulative stress, increases risk of mistakes, and diminishes confidence in subsequent trades. Over time, this creates a psychological drag, a fog of uncertainty that undermines even the best strategies. By limiting trades, professionals conserve emotional bandwidth, ensuring that their judgment remains sharp when the market actually presents a high probability opportunity. This discipline acts as a firewall against the erosion of skill caused by fatigue, bias, and impatience. Scarcity fosters respect for the market. It teaches that every decision carries weight. It enforces mindfulness in execution. The 20-trade limit also transforms the way traders perceive opportunity. With fewer shots at the market, each one gains significance. Professionals stop chasing setups that are marginal or speculative. They filter ruthlessly for quality. Weighting becomes a lens through which risk is assessed more accurately, and probability is interpreted with precision. The amateur's fear of missing out is replaced by the professional's focus on maximizing the value of each trade. The mind shifts from a reactive state to a proactive one, analyzing the conditions of the market and preparing to strike with confidence. This mental calibration is the hidden advantage that amateurs rarely recognize until disaster strikes. Patience as a position also amplifies the professional's edge in markets, characterized by volatility and noise. Markets rarely present perfect opportunities every day. A trader who treats waiting as action understands that inaction is profitable when the odds are unfavorable. Acting without alignment yields suboptimal results. Waiting preserves capital and energy for high-probability setups. This mindset is reinforced by the limit. When only 20 trades are allowed, every non-trade carries implicit value. Each missed setup that does not meet criteria is an act of gain, not loss. Scarcity transforms every decision into a calculated advantage. Another critical aspect of waiting is that it prevents psychological contamination between trades. When traders overtrade, emotions from one trade bleed into the next. A loss triggers revenge trading. A win fosters overconfidence. Both distort judgment and amplify risk. Limiting trades enforces a buffer, ensuring that each trade is approached freshly, without residual emotional noise. Professionals understand this. Amateurs often don't. The disciplined trader approaches each position as independent, with a clear mind and a clean emotional slate. Waiting as a position reinforces this separation, creating mental clarity and enhancing decision quality. Overexposure also disguises itself as confidence, which makes waiting even more critical. When the amateur sees a streak of wins, they assume momentum is on their side and increase size and frequency. The professional recognizes this as a trap. Confidence is not opportunity. It is an emotional signal that must be tempered by discipline. The 20-trade limit enforces this tempering automatically. It makes restraint habitual and instinctive. Waiting becomes embedded in the trader's process, ensuring that action only occurs when probability and conviction align. This psychological transformation is the hidden multiplier of profitability. It turns restraint into strategy, patience into power, and limited activity into leverage. Finally, consider the broader implications of waiting as a position. It reshapes identity. The amateur defines themselves by action, by the number of trades taken, by the illusion of engagement. The professional defines themselves by clarity, precision, and survival. Waiting builds a mindset that prioritizes process over outcome, discipline over impulse, and observation over reaction. By making patience an active component of strategy, the trader aligns with the underlying rhythms of the market, rather than fighting against them. Scarcity becomes strength, inaction becomes a tool, and every trade becomes a deliberate expression of skill rather than a reaction to fear or boredom. In conclusion, understanding that waiting is a position transforms how traders approach markets fundamentally. It is the psychological core of the 20-trade rule. It converts inactivity into action, restraint into leverage, and patience into profit. Limiting trades enforces this mindset, forcing focus, discipline, and deliberate engagement. Every trade becomes a statement of conviction, every pause a demonstration of mastery. The amateur panics, the professional waits. The amateur acts impulsively, the professional acts selectively. Scarcity sharpens judgment, waiting preserves energy, and patience amplifies edge. In the next chapter, we will explore what happens when traders break this rule, when overexposure masquerades as confidence, and how the very principle of scarcity becomes the differentiator between survival and self-destruction in trading. Overexposure in trading doesn't always spring from greed. Sometimes, it creeps in silently, disguised as confidence after a run of easy wins. The amateur feels invincible, convinced the market is on their side rather than that they are riding probability. After a streak of profitable trades, they start believing in momentum, not the market's, but their own. They convince themselves, I can't miss. That illusion is seductive. It inflates size, doubles trade frequency, and erodes the discipline that once kept them alive. What begins as a string of success quickly mutates into reckless overextension. Winning streaks are the stealthiest danger of all because they lull the mind into false certainty, erasing caution with every tick of the tape. Livermore referred to this as the danger of the tape smiling at you. It's a poetic warning. Markets aren't kind. They don't reward bravado or hubris. They are designed to test confidence, often until self-destruction is imminent. The more you believe in your untouchable streak, the more you ignore the structural rules that govern survival. Professionals understand this deeply. Amateurs rarely see it until they are humbled by a sudden reversal. Professionals respond differently to success. After a strong run, they shrink their size. They narrow focus. They return to structure. They understand the concept of a heat limit, the threshold at which confidence turns into overexposure. Every trader has one, whether they acknowledge it or not. Professionals know that exceeding it is a recipe for ruin. They don't chase the illusion of invincibility. They preserve equilibrium. Their aim is not to maximize the number of trades or the speed of execution, but to maintain balance in capital, risk, and emotion. Each decision is measured against the standard of survival rather than the fleeting validation of winning. By contrast, the amateur's natural tendency is to destroy equilibrium without realizing it. The amateur treats a winning streak like a green light to accelerate, to inflate positions, and to trade more often than the market will allow. The result is predictable: increased exposure, fractured discipline, and heightened risk. When the amateur reaches the 20th trade and still feels the urge to enter another, they rarely recognize what is driving them. It's not opportunity whispering. It's ego screaming for validation. Each additional trade beyond the limit is no longer strategic. It is psychological compensation. The professional sees this immediately. They understand that true opportunity doesn't demand validation, and it doesn't beg for attention. Opportunity waits for patience and alignment. The 20-trade limit acts as both a safeguard and a compass. It enforces discipline mechanically, reminding traders that the market rewards structure, not impulse. Those who exceed it are no longer trading probability, they are gambling, guided by pride rather than principle. This is why the confidence trap is so insidious. Early success fuels overconfidence. Overconfidence erodes discipline, and discipline is the scaffolding that separates survival from failure. Professionals preempt this cycle by tightening their operational parameters after wins, reducing risk, and reinforcing the boundaries that ensure longevity. They know that market conditions are transient, and that yesterday's favorable moves offer no guarantees for tomorrow. By shrinking position size and narrowing focus, they create a buffer between confidence and overexposure, ensuring that each trade remains an independent event, judged on merit rather than momentum. The psychological mechanics are fascinating. Humans are wired to reinforce behaviors that produce immediate reward. A winning streak triggers dopamine, creating a sense of certainty. The amateur interprets this chemical reinforcement as skill, ignoring the underlying structure that produced it. The professional interprets it differently. They understand that the streak is a signal to enforce even stricter rules. They know that overconfidence is a precursor to emotional and financial damage. In essence, the professional weaponizes success by using it as a checkpoint, not a license to abandon restraint. Consider the implications on trade selection. After a string of wins, The amateur widens criteria. They chase marginal setups, inflate size indiscriminately, and rationalize impulsive entries. Each deviation from disciplined limits multiplies hidden risk. The professional, constrained by a trade limit, cannot do this. Scarcity forces focus. Patience becomes a filter. Only trades that meet predefined criteria are considered. The limit becomes a behavioral safeguard against psychological distortion. When every trade counts, probability regains its proper influence. The professional's edge is preserved because discipline outweighs emotion, structure outweighs impulse. Another layer to the confidence trap is its invisibility. Overconfidence disguises itself as rational analysis. The amateur justifies extra trades with logic that sounds reasonable. The setup is strong, or the market is trending. But the underlying driver is psychological. Ego seeks affirmation, not opportunity. The professional recognizes this pattern. They monitor their impulses, note emotional spikes, and consciously adhere to the 20-trade ceiling. By doing so, they maintain clarity. They maintain equilibrium. They treat winning streaks as opportunities to reinforce discipline rather than abandon it. The professional approach also includes recalibration after success. After a period of profits, they may reduce size, reduce frequency, and return to core setups. This is not punishment. It is strategic reinforcement. It protects against the subtle erosion of judgment that comes with repeated wins. It ensures that probability, not emotion, governs future decisions. The 20-trade limit acts as the foundation for this approach, converting success into structured caution. Every trade is still counted, every opportunity measured, but the process prioritizes survival, consistency, and long-term gain. The contrast between amateur and professional could not be clearer. The amateur rides momentum, mistaking personal triumph for market validation. They escalate size and frequency, increasing exposure and risk without noticing the erosion of discipline. The professional, in contrast, tempers success with restraint, reduces risk, and maintains emotional equilibrium. Their focus is process, not outcome. They understand that the market is not there to confirm ego. It is there to test it. Survival, clarity, and process take precedence over short-term gratification. At a higher level, the confidence trap teaches an essential lesson about self-awareness. Markets exploit not just technical mistakes, but psychological vulnerability. The limit of 20 trades serves as both a behavioral compass and a protective boundary. It reminds traders that every action has consequence, that overconfidence carries hidden risk, and that discipline is the true lever of advantage. When you reach the point of craving more than your allotted trades, it is never opportunity, it is ego seeking validation. Recognizing this distinction is a hallmark of professional trading. The lesson here is also timeless. In trading, as in life, success can blind as easily as failure can instruct. Winning streaks are tests, not rewards. Professionals treat them as signals to tighten rules, enforce limits, and maintain focus. They shrink size, filter opportunities, and return to structured routines. The amateur interprets them as permission to accelerate, overextend, and gamble. The divergence in outcome is stark. This is why the 20-trade system exists, not to limit profit, but to protect equilibrium, to preserve capital, and to enforce the behavioral discipline that makes long-term survival possible. Ultimately, the confidence trap is about identity and self-regulation. The amateur's identity is tethered to action and validation. The professional's identity is anchored in discipline, process, and awareness of limits. Every trade beyond the limit is a step toward the amateur's destruction. Every trade within the limit reinforces the professional's edge. When you hit 20 trades and still crave more, it is never opportunity speaking, it is ego. Understanding this distinction allows the trader to implement the 20-trade system as a calibration tool, ensuring they remain alive and in control long enough to compound advantage over years. The next chapter will reveal exactly how to operationalize this system not as a cage, but as a framework that converts restraint into wealth, patience into power, and limits into leverage. Here's how professionals implement the 20-trade rule in practice, and why it transforms trading from chance into a disciplined system. Before the month begins, they pre-allocate 20 tokens, each representing a single trade for that period. Every entry costs 1 token, and once the tokens are gone, that's it. No resets, no emotional loopholes. This simple framework converts an abstract idea into a tangible ritual. It forces traders to treat every opportunity as precious, to analyze setups with scrutiny, and to act only when conviction aligns with probability. Discipline is no longer optional, it becomes operational. Each token represents more than capital. It represents attention, patience, and emotional energy. Professionals begin to value trades the way a sniper values a bullet, knowing that every action carries weight, and that wasted effort diminishes survival odds. Over time, this scarcity changes perception. When the number of trades is limited, the trader stops scanning indiscriminately. The search for setups becomes a search for confirmation. Charts, patterns, tape movement all become signals rather than distractions. Emotional capital is preserved because the trader no longer trades out of boredom, anxiety, or the illusion of momentum. Amateurs spend their mental energy chasing motion. Professionals invest patience waiting for pivotal points, the critical moments when the market signals alignment with probability. Livermore referred to these as the moments when the market tips its hand. If you are overtrading, scanning indiscriminately, and acting impulsively, you will never see these moments. Noise drowns signal. Impatience blinds judgment. Scarcity is the antidote, converting restraint into a tactical advantage. The token system also instills accountability. With every trade, the trader asks, is this token worth spending? Will this trade justify its place in my limited allotment? Over time, this fosters a mindset of critical evaluation, teaching the trader to quantify conviction and measure risk precisely. Each execution is deliberate, each decision reinforced by the mental discipline required to conserve tokens. This methodology extends beyond mechanics. It rewires cognition. The trader begins to internalize patience as a strategic asset, rather than a passive state. Waiting becomes proactive. Inaction is no longer guilt-inducing. It is capital-preserving. Scarcity produces focus, and focus produces consistency. Furthermore, limiting trades reshapes the approach to market opportunity. When every trade counts, the trader begins to filter aggressively. Marginal setups are ignored. Only high-probability alignments meet the criteria. This changes the quality of decisions dramatically. Each trade carries more weight, and the trader's average execution quality rises. The emotional cost of errors diminishes because trades are fewer, measured, and intentional. Over time, this produces an asymmetric advantage. Fewer trades, higher conviction, and greater survivability. Amateurs act constantly, often on marginal signals, diluting the quality of each position. Professionals understand that less is more, less noise, less impulsivity, less risk, and the system enforces this philosophy mechanically. The 20-trade system also enhances risk management in practical terms. By pre-allocating a fixed number of trades, the trader is forced to respect position sizing, stop-loss placement, and risk per trade. Emotional decisions driven by fear or greed have no room to dominate behavior. The structure ensures that the trader cannot exceed aggregate exposure limits, and in doing so, preserves the ability to survive market variance. Survival is the ultimate prerequisite for compounding skill and capital over time. The maxim becomes clear. Survival is profit. No amount of clever strategy matters if you are not in the game tomorrow. Another subtle benefit of the system is psychological conditioning. Each unused token reinforces patience. Each spent token reinforces responsibility. Traders develop a natural rhythm of observation and execution. The mind becomes attuned to probabilities and confirmation rather than impulse. Scarcity teaches discipline organically. transforming behavior at a subconscious level. Over time, traders who follow this system begin to operate from a state of calm anticipation rather than reactive anxiety. The emotional stability gained through this practice is arguably more valuable than any monetary gain because it prevents the erosion of skill caused by overtrading, impatience, and poor judgment. Importantly, the 20 trade limit is not about less profit. It is about controlled profit and long-term survival. Many amateurs misinterpret scarcity as restriction. They believe fewer trades mean fewer opportunities to earn. The opposite is true. By concentrating effort, emotional energy, and capital into the highest probability trades, the professional increases the efficiency of every decision. Each trade has higher expected value, and each mistake carries proportionally lower cost because exposure is constrained. The result is not only protection against ruin, but also amplified long-term profitability. Scarcity, when enforced rigorously, becomes leverage of the highest order. The methodology also bridges discipline and observation. By limiting trades, the professional can focus on market structure, price behavior, and pivotal points rather than transient fluctuations. Attention is conserved for critical moments, enabling more precise timing and execution. Overtrading dilutes judgment. The token system prevents this dilution. The professional is able to distinguish between ordinary noise and meaningful signal, and this distinction directly translates into superior performance. Marginal setups are filtered out. Only trades with high conviction pass the screen. This is the operational definition of professionalism in trading. Structured attention, applied to limited opportunities, with maximal focus and discipline. In practice, this system also builds trust in one's process. By treating every token as valuable, the trader learns to rely on strategy rather than impulse. They internalize the principle that the market will continue to offer opportunities indefinitely, but their own resources, mental, emotional, and capital, are finite. By respecting limits, they align behavior with probability rather than with desire. Scarcity enforces the habit of deliberate action and discourages reactionary impulses. Emotional, intelligence, judgment, and technical skill are all amplified by this simple structural framework. Ultimately, the 20 trade limit serves as a framework for professional identity. It transforms trading from an emotional roller coaster into a disciplined system of measured risk, selective engagement, and patient observation. Professionals are not defined by the number of trades they take, but by the quality and intentionality of those trades. They invest attention where it matters most, conserve emotional capital where it matters least, and respect the underlying probabilities of the market. Scarcity becomes the scaffolding on which profitable behavior is built. Patience becomes the active tool of engagement, and discipline transforms into a self-reinforcing operating system. By applying the 20-token methodology consistently, traders develop not only operational proficiency, but also mental resilience. They cultivate focus, patience, and emotional stability. They learn to filter noise, observe confirmation, and act decisively when opportunity aligns with probability. Each trade carries meaning. Each pause carries power. The system converts theoretical discipline into tangible execution, transforming abstract principles into actionable behavior. Survival, clarity, and selectivity become habitual. Over time, this structure creates an edge that is durable, replicable, and deeply aligned with the realities of the market. In conclusion, the discipline operating system is not about restriction. It is about empowerment. It converts the 20 trade rule from an abstract guideline into a living, functional methodology. Scarcity teaches judgment. Limitation enforces patience. Tokens cultivate focus. Each trade becomes intentional. Each pause deliberate. Emotional capital is preserved. Probability governs execution. And survival is prioritized above all else. The professional emerges not because of superior luck, but because of structure, discipline, and mastery of process. In the final chapter, we will close the loop, revealing why the 20-trade limit is not just tactical, but an act of self-respect, and how embracing it can permanently transform your trading identity, turning limitation into leverage, patience into power, and discipline into profit. Every professional eventually realizes a fundamental truth. The market rewards restraint more than brilliance. Skill without discipline is wasted. Insight without patience is squandered. The 20-trade limit exemplifies this principle. It isn't about counting trades for the sake of record-keeping or artificial scarcity. It's about counting moments of clarity, the instances when your attention, conviction, and judgment align perfectly with market conditions. Each token, each permitted trade, becomes a concentrated expression of intentional action, not noise. Scarcity sharpens perception. Patience amplifies execution. Respect for risk becomes ingrained. Over time, these psychological dividends accumulate into a form of wealth that no chart, strategy, or indicator can replicate. Traders begin to understand that success is not measured by the number of positions they take, but by the quality of thought, discipline, and process that guides every single one. The beauty of the 20-trade limit lies in its dual purpose, practical and psychological. On the practical side, it controls exposure, limits overtrading, and enforces risk management. It prevents the compounding of errors that arises when emotional fatigue or impulsive behavior infiltrates decisions. On the psychological side, it teaches discipline, patience, and the power of waiting. Every unused opportunity becomes a lesson in restraint. Every deliberate trade becomes a reinforcement of professionalism. Traders learn to value waiting as much as execution, to trust process over outcome, and to respect both capital and emotion as finite resources. Scarcity, in this sense, is not deprivation. It is a teacher. It forces the mind to prioritize, focus, and act only when conditions warrant. Jesse Livermore's story exemplifies both the promise and the peril of trading brilliance. His genius allowed him to see patterns and anticipate market behavior in ways few could. Yet his tragedy wasn't merely financial loss, it was loss of control. At times, his emotional impulses overrode his discipline, exposing him to overexposure, ruin, and despair. The 20-trade limit exists precisely to prevent that outcome. It is a firewall between insight and indulgence, between opportunity and ego. When a trader respects limits, they are not constrained, they are protected. Overexposure is dangerous not because of the market, but because it transforms a trader into their own adversary. They are no longer trading charts, patterns, or probabilities. They are trading anxiety, greed, and ego. The limit restores equilibrium, creating a mental and emotional framework where decisions are measured, deliberate, and sustainable. Here's a maxim that captures the essence of this philosophy. A limited number of trades creates unlimited clarity. Think about it. When you know you have a finite number of opportunities, every observation matters. Every setup is examined critically. Emotional energy is conserved. Attention is allocated strategically. Each trade becomes a signal of intention, not a reaction to impulse. Clarity emerges from constraint. Precision emerges from patience, and profit emerges from survival. In practice, this translates into 4 fundamental behaviors: cut losses fast, size small, wait deliberately, and own your process. Every other action follows from these principles. Discipline is no longer an abstract idea. It is operationalized, actionable, and measurable. The discipline dividend also reinforces professional identity. Amateurs define themselves by volume and action, constantly chasing screens, charts, and fleeting setups. They seek validation in activity, often at the expense of clarity, risk control, and composure. Professionals define themselves by restraint, focus, and adherence to process. Every trade is a reflection of judgment, patience, and intentionality. Scarcity teaches selectivity. Limitation teaches prudence. Waiting teaches patience. Emotional capital is preserved. Over time, the 20 trade rule internalizes these behaviors, embedding them into habit, cognition, and identity. What begins as a structural rule becomes a core feature of professional thinking. Another critical aspect of the discipline dividend is resilience. Markets are inherently volatile, unpredictable, and often cruel. Without a framework for restraint, even skilled traders can succumb to overtrading, emotional depletion, and impulsive risk-taking. By enforcing a hard limit, the professional reduces exposure to these psychological pitfalls. Each token spent becomes a measured expression of skill. Each token saved reinforces judgment. The trader develops confidence rooted in process rather than outcome. This confidence is sustainable because it is built on a foundation of discipline, not ego. It is quiet, resilient, and self-reinforcing. The 20 trade limit also teaches anticipation and observation. When trades are scarce, the trader's focus shifts from quantity to quality. They learn to observe market dynamics closely, waiting for pivotal points where probabilities align with conviction. Marginal signals are ignored. Only high-quality setups are acted upon. Patience becomes a strategy rather than a default. In this state, traders no longer react to every tick, news headline, or social media rumor. Instead, they position themselves mentally and emotionally for the moments that truly matter. The result is higher probability execution, lower emotional exposure, and amplified long-term performance. Importantly, this system creates a feedback loop between psychology and performance. Each deliberate trade reinforces the value of patience and discipline. Each avoided, impulsive trade reinforces the cost of overexposure. Emotional resilience grows alongside technical skill. Traders begin to trust their process, to observe rather than chase, to act rather than react. They internalize that survival, staying in the game with capital, composure, and clarity intact, is the prerequisite for compounding both skill and profit. In markets, survival is not a passive state. It is the ultimate form of advantage. The disciplined dividend extends beyond risk management into the realm of identity and long-term professional growth. Traders learn to respect their own limits, honor their process, and cultivate a mindset that values control over reaction. They recognize that opportunity is endless, but their attention, patience, and emotional capital are finite. The 20 trade system converts this understanding into structured behavior, ensuring that decisions are made consciously, deliberately, and with maximal alignment to probability. Traders learn that DB sense understanding to 1. Subscribe to sense of his finder. Restraint is not weakness, it is leverage. Limitation is not restriction, it is power. Finally, the 20 trade limit leaves an enduring lesson. Mastery of exposure precedes mastery of profit. Trading is not about how many positions you can take, how fast you can enter, or how large your wins can be. It is about surviving, observing, and executing in alignment with probability and process. Every trader who understands this principle internalizes the paradox. By limiting activity, you expand clarity. By constraining trades, you amplify execution quality. By exercising discipline, you unlock the real wealth of trading: psychological, operational, and financial. When the temptation to overtrade resurfaces, the reminder is simple. You do not need more trades. You need more discipline. Focus, patience, and adherence to process will always compound longer than impulsive action ever could. As we close this series, remember, the 20 trade limit is not merely a tactical rule, it is an act of self-respect. It protects against overexposure, preserves capital and composure, and cultivates psychological wealth. The true dividend of restraint is clarity, patience, and long-term survivability. Apply it rigorously. Cut losses fast. Size small. Wait deliberately. Own your process. Scarcity transforms into power, patience transforms into profit, and discipline transforms into freedom. And when you are ready, the next lesson: how professionals pyramid winners without losing composure, will take the principles of exposure, patience, and restraint to an even higher level. Mastering the limit is only the foundation. The real growth begins when you learn to compound it intelligently.